Good afternoon. Welcome to the December 2023 Executive Committee of the Board of Education Retirement Systems. Today is Thursday, December 14, 2023, and the time is 12:45 p.m. As a reminder, please note that the committee meeting is being recorded and will be posted to the BERS YouTube channel. I'll start the meeting by calling the roll. John Madrick.
Present.
Donald Nesbitt. Present. Gregory Faulkner. Anthony Giordano.
Present.
Green Holland. We do have quorum. I'd like to note for the record that additional trustees are present. Aisha, Alice Ho. Additionally, Allison Hirsch, designee for New York City Comptroller Brad Lander, is in attendance. Anyone else? Did I miss anyone?
Some folks on WebEx.
Okay, on WebEx, 1 second. Yes. We have
Off of it, don't pause the recording. Two people off the call.
we have Efri Zachary.
Hello, everyone.
Hello, thank you.
Rena's here.
And to note for the record, we have Bryn here.
Gregory Faulkner's on his way.
And I'll note for the record that Gregory Faulkner is on his way. Okay. So, agenda 1 is to consider the minutes from the November 2023 Executive Committee meeting, a summary of which was included in your packet sent prior to this meeting. May I get a motion to approve the minutes?
Motion.
Thank you. May I have a second?
Second.
Okay, thank you. Any discussion? All those in favor, please say aye.
Aye.
Thank you. Any opposed? Any abstentions? The motion carries. There's no contract items, though we do have a busy agenda with for today. Agenda item number 3, we'll start with initial comments by myself, Salameta, concerning just table setting for today's meeting, a little bit of background on what we discussed in the previous meeting, and some of the implications on performance, on funding ratios, and some of the speakers for discussion. Just take a few minutes. May I have a motion to consider? Thank you, Tony. May I have a second?
Second.
Thank you, Don. Okay, so in the last executive committee meeting in November, there were 2 major topics that were discussed. The first was looking at excess returns in public markets. We looked at this across different time horizons and different asset classes, talked to the drivers of excess returns. The second, and also I should note that Siegel had complimentary presentations on these topics as well. We also talked about minimum commitments and the pros and cons of changing minimum commitments within private markets. And within that, there was some specific fact points that are worth mentioning for today. One of them is we had a drop in public markets in calendar year 2022. We did not have a drop in public markets in this current calendar year. We saw a mirror image somewhat for rebound. And we forward to a year ago, if you look at like private equity as an asset class, we were at 12% weight, and we were projected at that time to go down to 11.5, and then we came up with the some of the pacing commitment numbers. It was 215 if it was 9% growth, 180 if it was 7%, and we wound up doing 230 and then we did a 40 million Newburgh Berman. But we went up to 12.5 in a public market that rose. And so there wasn't as much of that denominator effect, but other things that can't necessarily be reconciled with pacings and commitments. But if we were at the 11.5% that was predicted in terms of the weight, then our new asset allocation at 8%, we wouldn't necessarily need to change the tolerance 4% on that. So that's just one thing to keep in mind there. The other thing is in terms of performance, whether you look at the calendar year to date or the quarter or the fiscal year to date, the public markets have performed very strongly, more so than the private markets. And the private markets, we're seeing a little bit of negative excess returns, but the weight that's coming from the private markets means that our overall returns will be shy of the 7% target return that we try to get over periods of time. So over the since the last published funding ratio numbers, I see a drop in our funding ratio of maybe a couple percentage points plus or minus. It's not that significant on a short period of time. It would be significant if that were to continue. We're still in the high 90s, but it's something to be mindful of. We will talk in future months about SOPM from the rest of the team, that's operating procedures. And today's presentations will first talk with Siegel. They'll have 4 topics. They'll talk about things that will include market performance, minimum commitments, secondary sales, and tolerance bands in the IPS. We'll also have Sandra from Oxia, who will talk about the market overview in private markets, as well as pacing commitments and some ideas on that. We'll have a capstone presentation. I think it's going to be a brief one from the BAM CIO, Steve, to look at what's been done so far in terms of implementing and rebalancing the public market section of the portfolio to accommodate the new asset allocation. So that's just a quick summary of where we are, where we're going. Any discussion, or should we go straight to the presentations? Okay, so thank you. So next on agenda 3, we have comments from General Consultant Siegel Marco on items that talked about the markets and other items. May I have a motion to consider?
So moved.
Thank you. I think that was Tony. May I have a second?
Second.
Second was who? Not a call.
Second from John.
Thank you, John. I'll now turn it over to Siegel, maybe 15, 20 minutes where, I'm going to pull up your slides. Yeah.
Yeah.
Bear with me.
Yeah, let me come up.
Yep.
Okay.
Perfect, thank you.
Good afternoon. So we're gonna start with just a little bit of a summary of what we did in September. So in September, when we presented to all of you the new asset allocation, we knew, I remember we showed you the June numbers in terms of where you were in comparison to the asset allocation that you were approving in September. As you can see here, I've updated the numbers through September. So you can see where you have overweights and where you have underweights in comparison to the approved, now the new approved asset allocation. The first 7 asset classes on this list is what we call the liquid asset classes. So those are tradable, BAM as your the custodian of your assets basically will get you to the target or close to the target based on trading, and that's that can be implemented at any time now that the asset allocation is approved. The asset classes in the bottom, the last 4 asset classes in the bottom, is what we call illiquid asset classes that are not tradable like the ones in the top, so they will take some time to get to.
That's gone. That's gone.
One second. If you can mute yourself if you're on the call, unless you need to say something, and then you speak
Yeah,
up.
I'm sorry. Can you please share the presentation on WebEx? I don't
Yes.
see it being
Yes,
presented.
1 second.
Thank you.
Can you see it, everyone? Can someone confirm they can see the screen?
We see it now.
Yes,
See it
thank you.
now.
Confirmed.
Thank you.
Sorry about the oversight.
So I would say the last 4 asset classes are your illiquid asset classes, and they are going to take a little bit of time to get to the target. And those that are, which Axia is responsible to help you with pacing to get to the target allocation. That's part of their part of the what they need to do as your consultants, your private markets consultants. At the last meeting, we introduced 2 different type of bands when it comes to the rebalancing ranges. So if you go to the next slide, Salil, please. What we've done is to show you how those 2 bands look like. So if you recall at the last meeting, we talked about 2 different upper bands in private equity alone. Because we had some concerns that by raising the band, that what will happen to the target allocation? Are we going to get there faster or not faster because we're raising the bands? The reality is that the plan to get to target allocation does not get affected by the bands in your IPS for rebalancing ranges. Your IPS right now in terms of rebalancing for private asset classes is silent. And to do any sort of secondary transaction, it actually takes a lot of time because you have procurement. You would need brokers. Right now, there's not a broker. You would have to do it. And you have to basically give discretion, or BAM would have discretion to act really fast, because a lot of times you need to act really fast when you're doing things like that. And I don't even want to tell you what an estimate is to do a secondary transaction, but I know that it's not going to happen in 3 months. That I can tell you for sure. And
And the discounts in the market.
oh yeah, the discounts is, I'm just talking about just from a operational basis. I know it's not going to take 3 months. So when we originally proposed, the Siegel Marco proposed a 6% upper bound to private equity. Even though we knew that we were reducing the target allocation, the reason why we proposed that is because your September number of where you are, current allocation is 11.9. If we were to continue with a 4% upper bound, you're 50 basis points from going over that rebalancing range. So what's the point of having of coming to you all and giving you a range that I know you're going to breach in the future, and you're not going to be able to sell in 3 months. So the reason was, let's give you a little bit of more cushion in the rebalancing range, still acknowledge that we need a plan to get to target, because now you have a lower allocation to private equity, but give you a rebalancing range with a cushion. So the chart that you have here has the rebalancing ranges that we proposed and we discussed at the last meeting. Just concentrate to the box that is in the square. That's private equity. The green is your target. The diamond is where you are in September, with the goal of bringing that diamond back down. But it's gonna take a while, and it's gonna depend on the pacing that you're gonna be approving every year. And also, another recommendation that we had for the IPS was going to reduce that $25 million minimum. Because that way you're able to put more money to work throughout the year without getting really fast to your pacing in private at $25 million minimum. So the next page shows you what that 4% upper bound looks like. So as you see here, So this is the same graph with the same numbers across everything, but you see how the triangle, which is your current allocation now, it's almost right at the top. So as trustees, it is really up to you where you feel comfortable in terms of the rebalancing ranges. But if you reach a rebalancing range in an asset class that is liquid, you just need to, in your meeting notes, acknowledge that you have reached the range, and that you're working on a pacing that you have approved as of the day that you approve your pacing, and that you will get back there at some point, but it could take you, you could be a whole year outside of your rebalancing range. But it's really, that is really up to you as trustees, where you feel more comfortable. I'm gonna stop and see if there's any questions. If you ask me for my recommendation would be to use the 6%. And make sure that throughout the year, you approve pacing once a year, but throughout the year, you do a check-in in terms of where we are in pacing, where we are in current allocation, and what we have approved. And just monitor it more closely throughout the years. And then when you go next, the follow, so 2024, think about it, December 2024, when you're ready for the next pacing for the following year. We'll see where we are, and we'll see if we can bring that if it makes sense to bring that upper limit a little bit down.
Are there any questions online? The interface we have is a little clunky, so I can't, please just speak up if there is, instead of.
I have my hand raised, but if you can't see it,
please
I'll
go
just
ahead.
speak out.
Not
Hi, this
see it,
is
sorry.
Effie Zachary, one of the BERS trustees.
Yeah, go ahead, speak.
I'm sorry, can you hear me?
Yes,
Zachary,
go ahead.
Can you hear us?
I really have more of a comment than a question to the benefit of the trustees. I think it's very important for us to distinguish why are we off target. So if in this case the equity market had a phenomenal success and it went up a lot percentage wise, and that's why we are way above target, that's actually a good thing. We had great positive returns, and we would be foolish to say like, oh, next year the equity markets are going to tank, and yay, they tanked, now we are back on target. That's like not just the target alone shouldn't be like what drives us. We have to like understand like what is going on. In my opinion, we are above target not because of denominator effects, especially not in the past year. It's really because we over allocated to that sector, to private equities. And I think we have to be mindful going forward that we don't want, I think we done it too concentrated. That's my personal opinion, meaning that in the past 2 years, we put a lot of money there and a lot of it is locked for maybe 10 years. So we have no liquidity coming up for maybe the next 7-8 years. And then suddenly like 9-10 years from now, we're going to have a lot of them maybe exiting. And so we're going to be like in a situation where we have like very poor liquidity, and then we have too much cash on hand. And I think it would be shrewd of us to be a little more careful in how we pace going forward. I think it's much better to kind of make it a little bit more gradual. So like every year we put a little bit in private equity, and every year a little bit gets exited. And it's kind of a smooth transition and not like all or nothing kind of situation, which is kind of what we are facing right now. So that's kind of my overall impression of what we should do in private equity. I'm also definitely for reducing the $25 million investment threshold. If we go down to, let's say, 5, we can always put 25. There's nothing that prevents us from doing it anyway, but it gives us options to invest smaller amounts. And I think it's better to invest smaller amounts in more different investments, and also over a different timeline, as opposed to a lot of money once at a time, and then having more liquidity issues and also less diversification. Thank you.
Thank you. I think Sandra also wanted to chime in.
Effie, hi, this is Sandra Vitals from Axia. Thank you for the points that you raised, and just a couple of things that maybe will help address your question. One is, while it is absolutely true that you do lock up your money in a private equity manager for up to 10 years, and generally you get the distribution, the money back when it's sold, you do benefit from being part of a seasoned private equity portfolio. And Axia has been very mindful of your concerns around liquidity risks. So if you look at the back of the appendix of this desk, you'll see that you're actually getting both quarterly and annual distributions already out of your private equity portfolio. And in fact, if you look at your other private market investments, such as real estate or private credit, there you're getting cash flows back in the forms of payment from rent, leases, and typically loans are repaid earlier than the time it takes to sell a company. So the liquidity risk is very real when you're investing in private markets. But given the substantial amount of your portfolio invested in fixed income, and we know a lot of it goes towards meeting your benefit requirements, that relative to the cash flows we're seeing from all of your 4 private market portfolios should give you some comfort. And as for the over allocation, we will show you where this year you landed relative to the pacing we proposed. It's within the target range. It's with the last commitment that you approved to the Neuberger-Berman Northbound program, the emerging manager platform. You're $8 million above the pacing target. And today we look at a variety of scenarios that will help you rebalance. But Effie, to your point, we're very mindful of your concerns around liquidity risk. We're showing you how the cash flows work, and just reminding you that particularly for the diversification portfolios, you will get distributions back before, say, a building is sold or if a loan is fully paid off. And
All right,
actually, in the case
but the distributions are relatively very small percentage compared to the exit point. I look forward to seeing your rebalancing suggestions later. Thank you.
Thank you, Jeffrey. Vanessa, you also had more to your presentation. Was that the conclusion?
I have a question.
Yes, go ahead.
Thank you. So Vanessa, what's the risk here on vintage year risk if you reduce the annual pacing plan for this action here? And on B, is there a risk we'll be over diversified in managers if we reduce the threshold 25 million?
So because you will continue to have some allocation to private equity, you will get vintage year diversification. The vintage risk is if you decide not to allocate to private equity at all in a particular vintage, that's where that comes in. So you will approve a pacing for private equity. It will be lower, but you will approve, assets flowing into the asset class. In terms of the minimum, the risk that BERS has is that you would be allocated a small portion. As we know, the trustees don't set how much you commit to a manager. It is set by a recommendation from BAM and Axia together, and the memos come to the trustees. So the risk there is that if we lower it to say 5 million, that's the lowest that you're gonna get. I don't know, every manager is different, so they will decide differently what the overall commitment amount they get from the manager and how to get divided between the 5 systems. But if you as trustees, you need to be comfortable that if you set it at 5 and it comes at 5, that's how much you're gonna put in. If you set it at 10 and it comes at 10, that's how much you're gonna put in into a particular manager. There may be situations where, and I know this has happened, where Axia have been able to increase the commitment amount to BERS after negotiating with a manager. That can happen, but I cannot guarantee that that's going to happen in every single transaction that you may want to commit more money to.
But also point out, the last 2 comments are really valid. I think ideally, assuming a plan that is staying the same size over time, if Axia and BAM are perfect at modeling, we would allocate the exact same amount every year. That's the goal, right? The goal is and then if you allocate the same amount of money every year, 10 years down the line, you're getting back the same amount of money every year, roughly, right? But modeling's not perfect. So absolutely right, Effie, that the last couple of years have been bigger allocations to private equity, right? In retrospect, maybe they should have been a little smaller. Maybe the modeling wasn't perfect. Maybe there were some nuances that caused that to happen. That means that Next year, we'll have less vintage year diversification. It'll be a smaller year. The goal is to try to even it out as cleanly as possible so that we're trying to smooth that over time, and every year making a few adjustments to exactly avoid the problem that Effie was talking about, right? You don't want to have these cliffs. And just one clarification, distributions actually do include exits, Effie. So distributions is not just income payments. It's actually when a private equity manager sells a company, that comes back as a distribution, right? So that's all part of the pacing. So it is a very big part of the distributions are very important with respect to the cash flows and the liquidity of the plan. So yeah, how did we get here, right? We got here to an over allocation for a lot of reasons. It's not just one reason, right? Of course, everyone's talking about denominator effect. Denominator effect is real, and that's part of it. That's part of the reason why this is over allocated. Part of it's that you've decided to reduce the allocation of private equity, right? So that's another percent. That's a reason you're over. Part of it is that there was essentially the distributions have come back a little bit slower, right? So we expected there to be a little bit more cash flow, and the model was not perfect. And so there's a lot of different reasons why it's gotten to where it is. Now the goal here is that we kind of say we level set to where we are right now, and we set a plan for the next 5 years. We probably go on a little conservative side, right? And Sandra will get back to that when we get to the next presentation. But if you're looking at private equity, if you're looking at real estate and asset classes where you're over, we know it's an imperfect model. So let's allocate on the conservative side and allocate a little bit less to those asset classes to make sure that we're kind of trying to be as even as possible over time without breaching limits.
I would only have one more thing to add to that, which is if you look at the history of where BERS was relative to its target in private equity, since 2014 through about 2020, for those 6 years, on average, you're about 2 to 3% under your target. And it was basically every year we were running a scenario of the next 5 years, how we're going to get to your target. And it was a smooth upwards line where that gap was decreasing over time. And then what happened in 2021 was everything went up and to the right because of the post-pandemic recovery. You had all asset classes performing well. Private equity in particular performed very strongly. And that accelerated how quickly you got to your target. And roughly halfway through 2021, you actually hit your target for the first time in 7 years. And then in 2022, the denominator effect did occur, and that overallocation was fairly exacerbated. So there were two big macro events that led to the position that you're in now. But it's important to orient the fact that for the prior 8 years, you were about 2% below target. And now for some period of time, you're going to be 2% or 3% above target. And it will take time to get back down to that target that you've recently approved.
So just clarify that you can get some brass tacks on the table in terms of what the three comments have been. Okay, so we had Salil coming in and saying and basically opining that we're up, but it's not necessarily denominator effect related in this year, at least in this current year. Siegel is saying that if we were at the original 4% band, we'd already be over that band. So we should expand that 50 basis points away. So we should go to the 6. And Axia is kind of saying that, okay, we are over or close to over, but we're kind of okay. And Anaj is like, we were underneath, so it's okay to be over now. Is that kind of what the gist of it? If I'm surmising everything that's being brought together right now?
If I can just summarize the Axia portion of that, I wouldn't say it's over. You're over and it's okay to be over. You're over. Fact, right? You are over. Now we're coming up with a plan of how you get back on target in as smooth a way as possible.
And I would say that the 6% ban is to accommodate that plan.
I understand.
Yeah. If I could also comment, and I apologize for not being there in person, trustees, it's Steve Meyer. I actually applaud the idea of at least acknowledging that we're overweight over the target with the change in allocation moving down in private equity. So I think it's part of a discipline and I think a requirement as we look at these allocations. If we're outside of a target band, I think it's important for the trustees to note that. And frankly, you don't want to go through the process of selling assets at a discount. And I think Patrick and his colleague at Axia are absolutely correct that we'll adjust this over time through the pacing plan. The other point that Vanessa made, and it was an answer to Effie's question around liquidity, we don't rely on private assets for liquidity. You have more than enough liquidity in your public assets, fixed income, and equity allocation. So shouldn't be a concern or a worry for the trustees in terms of our ability to make benefit payments as they occur and to meet capital calls as they come up.
That's Jim Moore.
I just want to say, I did include in the materials, the updated traffic light. I actually don't want to present it because I know that it will take us 20 minutes to go over every single manager. Performance was positive across the board. In November, managers that had been underperforming their benchmark on a year-to-date basis by a lot actually reduced that significantly in November. But that's for all of you to see, and we can, take it on in January when we get December numbers for a full calendar year. But that is included in the materials. But I know that it's a packed agenda, so I don't want to take a lot of your time. If that's okay with trustees.
So thank you for those comments. Next on the agenda. Oh, first of all, I wanted to acknowledge additional trustees who are in attendance. Gregory Faulkner, we have Venus, Singh, and Marjorie Sting. So next on agenda 3, we have comments from specialty consultant Axia, including on markets overview and some of the pays and commitments. We'll continue that discussion for calendar year 2024. May I have a motion to consider? Thank you, John. May I have a second?
Second.
Thank you, Donald. And now I'll turn it over to Sandra, 25 minutes or whatever.
Thank you for being here today, and we would like to just do a quick refresh on how this pacing model, which is really just a tool in thinking about how much capital you need to commit across your 4 private market portfolios to support your current strategic asset allocation. So Nessa and her colleagues at Siegel Marco did the heavy lifting of figuring out if you are targeting a portfolio return between 7 and 8% and volatility, a risk range of roughly 13%, how would you divide your portfolio among your public and private markets book? And as we work for private markets, you can put on the first slide. As you may recall, last September, we reviewed and voted to approve the new recommendation, which consists of a 4% targeted allocation for infrastructure, 5% for opportunistic fixed income, 8% for real estate, and a reduction from 9 to 8% within private equity. Now, if you look below that, that shows your actual allocation to these 4 private market portfolios as of September. And as we're all aware, you're currently about 4.5% overweight in private equity, about 1% overweight in real estate. You're underweight with an opportunistic fixed income, and basically on target for infrastructure. And so the pacing analysis really is just a way of forecasting based on assuming how much you think the portfolio is going to grow and the cash flows, meaning the money the managers are going to call down, and then what you expect to get back as either they sell the assets or in some cases, as I noted earlier, are coming from coupon or income type payments. And our starting point, which is highlighted there, is 7%. And we choose that kind of as a starting point because it reflects Siegel Marco's strategic asset growth assumption for this asset allocation.
Is this going to specific managers?
No, this is at the asset class level.
The materials.
Some of the material.
The materials we cannot share on screen. Is that true? Is that what your concern is? That
My
part?
concern is that there's, can we
Yeah.
go off the record?
Oh, closed session, okay.
My concern is that there's manager-specific information in here that we haven't taken action on yet.
Right.
And so I just want to make sure that,
Is one solution to not go to those slides and just stay to the macro, or just defer this to executive
I mean,
session?
I would feel more comfortable deferring this
Okay.
to executive session so
Okay,
that we can.
so let's go
some
straight to
conversation.
executives then. Okay, give me just one moment. We have a motion to enter executive session.
So moved.
Second.
Thank you, Donald, and a second, thank you, Tony. Any final discussion? Okay, all those in favor of entering executive session indicate with an aye. People, any opposed? Any abstentions? Motion carries. We're going to go to executive session.
Motion for me to speak again, yes.
Oh, yeah, we'll have to turn off. Thank you. I'll now report out on executive session. In executive session, the board approved 4 funds: a recommitment to an infrastructure fund, a private credit opportunistic fixed income fund, a real estate fund, and a second infrastructure fund. Additionally, in executive session, we had a presentation on from one of the real estate funds, as well as a discussion of asset allocation for the BAM CIO. That was the last item on the agenda for today's executive committee meeting. The next meeting of the Board of Education Retirement Systems Executive Committee will be on Thursday, January 25, 2024 at noon. And I believe we have quorum, but continue to send in,
Happy New Year.
Thursday, January 25. The week before is the conference. If that's an issue, we can resolve it offline, but we do have at least 3 right now. May I have a motion to adjourn? this meeting?
Yes.
Thank you. Green, may I have a second?
Second, third,
Tony.
fourth,
All
fifth.
those in favor say aye. Thank you. We're adjourned. See you all next year. Happy holidays.